Have you ever heard some investing myths that you knew just were not true? In today's video, we're going to be breaking down 5 common investment myths, really debunking them and having you understand why they are not real and why they are not prevalent to you. So let's go ahead and get into this. The first one we look at, and this is the myth that I always hear from a lot of different individuals: you need a lot of money to start investing. That is not true. Now, once upon a time, many years ago, getting in the market was incredibly difficult. With the advancements that we've seen of fintechs, that we've seen of technology, that we've seen of investment houses, it is super easy. That is the biggest excuse that I've always seen when people look at different plans, when they look at IRAs, 401ks, when they look at different investment strategies. They do not have the money, or they do not have enough money to start investing. When you start thinking of investing, you imagine, high-powered Wall Street individuals that are making millions of dollars. Anyone can invest. And I do have some links right down below for M1 Finance. I believe it starts as low as $25 to start that investment journey, start putting money into those IRA accounts. Many investment firms have very small minimum requirements, or some have no requirement at all to open that account. Now, you can start funding the account as easy as just linking up your bank, putting money right in there, and picking out the investment strategy that works for you. Now, through applications, through online websites, through a fractional shares. Now, what that means when we think of fractional shares, meaning that if you have, let's say, a share that costs $1,000, you only invest 100, you own 10% of a 0.1% of that share, meaning that you are buying a fractional share of the company. You do not have to spend that $1,000 to buy one single share in its entirety. It is fractional investing, and that is a majority of how ETFs do work, and where I really advise you investing your money. Now, the second myth that we looked into: past performance guarantees future returns. This is one of the biggest myths that I see, short of not having the money. When you look at past performance, it is an indicator that shows what future performance could look like. There is no sure thing when it comes to investing. There is no guaranteed returns. There is no insurance on your investment products with the SIPC and a couple other ones. So if you bought $1,000 worth of stock, and then of course it went up to $10,000, you made a pretty good gain. Doesn't mean in 20 years you're going to be making $10,000. Doesn't mean in 5 years, 1 year, 1 month, whatever it may be. Even the past performance of a company, and when we start thinking of Apple, when you think of Nvidia, when you think of these companies that are, hundreds or thousands of percent returns in the next 10 years, doesn't really mean that it is going to be the exact same in the future. Successful investing is about really the fluid approach, putting money in on a regular basis and watching it compound. Now, to really accomplish this, I do dollar cost averaging. If you followed my channel for a while, and if you haven't, and if you're new, definitely consider subscribing. But when it comes to dollar cost averaging, we are putting in a set amount of money every single week, regardless of if the market is up, if the market is down. We are continuing with our dollar cost averaging, regardless of what Trump and the tariffs on and off again are going to do. We invest on a regular basis. This is the exact same approach when you start thinking of 401ks. Let's say you get paid every single 2 weeks. When the 2 weeks roll around, you're putting your money into your 401k. The company itself is making the contributions into that employment account, which is the exact way that people do love to do it. It uses that dollar cost average methodology and really takes it out of your hands because it is payroll deductions that your employer does. Now, looking at myth number 3, the 401k is the only way to save for retirement. So a lot of people think that the 401k is the catch-all when it comes to retirement accounts, but it is not. It is a very small part of really the bigger financial picture. When you start looking at the 401k, one, most people don't put enough money into their 401k to really be set for retirement. If you're putting in your 4%, chances are you're well below the average, which we know is about 5% of contributions. But recommended when it comes to 401k contributions is 15%. That is the recommended amount, regardless of if you're making $20,000 a year now, if it is 30 years down the road and you're making $50,000, $100,000, whatever it may be. Putting 15% for your entire working life, you are going to retire, and you are going to retire very well if you set it at that 15%. Now, there are also additional ways to save for retirement that are kind of indirect for some of them, including HSA accounts. Now, health savings accounts, if you are eligible, are a triple tax advantage account. When you make contributions, you can write it off your taxes. When it grows, you do not have to pay taxes. when you take the money out for qualified expenses, you do not have to pay taxes on this money. It is one of the accounts that I feel people that are eligible for them really underutilized, because when you look at the average cost during retirement for medical expenses that are not covered by Medicare, that are not covered by Medicaid, they're saying $75,000 to $85,000 during your retirement years that you could have into an HSA to cover all of those expenses. And that's just the average. Yours might be a little bit lower, mine might be a little bit higher. And then, of course, we have the IRAs. Now, when it comes to IRA accounts, the annual maximum contribution in 2025 is $7,000, which is far less than what you can contribute to those 401k plans. And there are also variations for both of these, the 401k and the IRA, as long as it's eligible from your employer. You have a Roth variation and you have a traditional variation. Now, the traditional is exactly what it sounds like. It is the way that IRAs used to be run. When you put money in there, you are getting a tax break today for the money that you're making contributions in both those traditional 401ks and the traditional IRAs, meaning that when you go in there, and you're claiming a smaller income today, but you are kicking that tax burden down the road. And I'll explain that in just a minute. The second one is a Roth IRA, and some companies have started doing Roth 401ks. Now, me personally, I love the Roth option. I would rather be liable and pay the taxes today versus paying the taxes later at whatever bracket is going to have for the government in the future, but also having to pay taxes on the growth that we're seeing within those plans itself can be very detrimental. Now, when you're ready to withdraw the money, like we said, if you look at a traditional plan, you are going to be hit with required minimum distributions, meaning there's a point in time you're going to be required through the IRS to start taking money out of your plan, out of that retirement plan where you've been stockpiling it, because they want their tax money. They want those tax dollars to come back. When you do the RMDs, you are required to pay tax on the money that is taken out. Now, in the other side of it, with the Roth IRAs and the Roth 401ks, you have already prepaid, all the taxes are paid. You're not required to take any money out of there at all if you choose not to. Now, number 4, investing is like gambling. There are no guarantees in investing, like we've said, but some people have compared it to gambling. Gambling, you are taking a very uncalculated risk. Every time you're putting money on the table, every time you're pulling the slot on the slot machine, it is a very uncalculated risk, with the house usually winning when it comes to gambling. Even though there's a lot of unknowns, there is risk when it comes to investing. If you build out your portfolio or really choose the investment vehicle that suits you, this is going to make the big difference. So there are a lot of different factors. If you want 100% guaranteed returns, looking at something like C's, looking at high yield savings accounts, even though the risk is not there, the return is going to be much lower, but you are guaranteed that you're not going to lose any money. Now, for me, like I said earlier, I invest in only ETFs. So instead of going in and buying, let's say, Facebook or Meta, going in and buying, Apple, or going in for Nvidia, I invest in the entire market itself. So I invest in that S&P 500, the 500 largest companies in the United States. That way I own all of those companies, and I do also own all of those companies across the sectors to really have a lot of risk mitigation in there, because we do own fractional shares and shares of those companies in the entirety, really minimizing the risk that we have for the long term. And when we start thinking about the S&P 500 performance over an extended amount of time, it has yielded about a 10.4% return on average, which is huge. Now, the final one in this one, investing in individual stocks is always the best. Now, if you got a hot tip, if you're looking at specific stocks, if you are new to investing, do your research. Companies come and go, and we have seen it through all of time. When companies start getting media attention, whether it is positive or negative, it can have a huge impact on the stock. Even looking today, what is going on with Tesla, everything with Elon, President Trump, Doge, everything else has really driven the price of Tesla stock very, very low. I believe it's like 50% off its all-time high, if not even higher, from where it is. This is the reason why we talk about the diversification of the portfolio, getting into those ETFs, getting into the diversification. And I really break it into 3 different factors in this one. Number 1, I'm going to have a really risky kind of tech side. That is going to be the big growth part of my portfolio. The second section we look at is that S&P 500. This is really focused in and building up the core or the foundation for the portfolio itself. And then I have my third section, which is based on dividend income. So even when the market does a pullback like we seen last week, we still have the ability to generate some dividend. And usually with dividends, you don't see the volatility up, but you also do not see the volatility as much when it goes down. The bottom line, guys, when it comes to investing, it is about investing over an extended amount of time and investing on a consistent basis to really get that to grow. At the end of the day, very important and not so important for the money you have, but you have to know how to invest, doing your strategy and knowing exactly what you want to invest in. All right, guys, so that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.